Rajesh Kothari is now joining us to take us through what he's making of things. He's, of course, director at AlfAccurate Advisors. Rajesh, great to have you with us here. Thank you very much. Just wanted your thoughts on Apollo Hospitals. I mean, if you have a view on the sector, it's pulled back a little bit. We were talking about this earlier. Your thoughts?
No, dear, we are not holding that company in our portfolio currently, so no views on the company as of now.
From the sector? Rajesh, anything else in the sector? This Fortis, Max?
No, we are not holding any company in the hospital segment. So, no views as such on the segment.
Rajesh, I was just looking at your portfolio construct, and the largest proportion you have allocated is to domestic recovery themes. And in that, I find Bajaj Finance as well, part of the list. The numbers looked very, very good. The stock is under some pressure today. But the numbers look good. Maybe it's with regard to valuations or maybe it's with regard to positioning. But how would you approach the stock from here? Would you be tempted to add at lower levels?
Definitely, yes. So we are holding roughly 40% of the portfolio into the, the domestic recovery. And that includes, the various sub-segments within that. So it includes capital goods, it includes banking and finance, and includes logistics and so on and so forth. In banking and finance, Bajaj Finance is one of the company which we continue to own. I think the yesterday results are very, very impressive, particularly on the asset quality front side, the credit cost guidance, and of course the transformation, the super app of Bajaj Finance. I think it's the best way to play the fintech, a company which is a profitable and of course with a large customer base. So if you look at the most of the companies in fintech which are coming with an IPO private equity, what the missing link is, they don't have customers and they have to spend heavily to get the customers. Whereas here is a company which is a number one in terms of the market share, has already got the customers and now putting the technology to make sure that they give the better experience to customer or make the operations more efficient. So it is actually a very, very profitable fintech company to play Indian banking and finance. So we continue to remain positive on this name.
Valuations don't deter you, Rajesh?
If you look at the most of the other companies which are getting valued now in the internet space, whether it's private equity or public equity, and many companies have reached 50,000 crore, 1 lakh crore kind of a market cap without much profits. I think probably you are absolutely right. The valuation actually are on the other side. I mean, from that metrics, if you look at it, you will find it is actually cheap. So what kind of growth you are buying it and what kind of a asset quality you are buying, that decides the valuation. Show me one NBFC which is a kind of a growth of Bajaj Finance with a net NPA number below 2%. There is none. Even within banking, actually you don't find except 1 or 2 numbers. So it's the best of the asset quality and best of the growth with the fintech as a super app on top of it. I think probably you are getting at a much reasonable valuations.
Rajesh, I'm going through your portfolio and it seems definitely you're tilting towards growth in comparison to value. Whether I look at Bajaj Finance or I look at an SRF or a Dixon, the list goes on, Titan and the likes. So clearly you're tilted towards growth-oriented names and you don't mind paying a bit of a premium for that. But let's focus on another set of stocks that have been in focus. Now 2022, the auto stocks that were underperformers in 21, they have started off with a bang, top gear, so to call it. How would you approach this space, or would you prefer the auto ancillary names?
I think we like both the sectors from here on. As you rightly mentioned, not only last 1 year, but last 3 years were very, very challenging for entire auto OEM space due to number of factors. And all of us are aware what kind of factors they were. So the cost has increased significantly in last 3 years. Now, from here on, I think, the valuations are quite reasonable. Probably they are on the other side of it. They are actually very, very attractive and the growth is going to resume. Within the space, we like the companies which are number one in their respective fields within auto OEM and probably CV player or passenger vehicle player. Both looks very good from here on. Also, we like the auto ancillary space, particularly for the companies which are going to be the major beneficiary of the new technology which is coming into automobile, whether it is a safety norms, whether it is a putting up more airbags, or whether it is a transition to EV. So the content per vehicle is going to go up significantly for a few of the large auto ancillary companies, and we like those names as well. So both auto and auto ancillaries on bottom-up basis I think it can be a very rewarding story for next 2-3 years.
Okay, Rajesh, just hold on to that thought. We're coming back to you. Well, we have a quiz that's going on. That's a budget quiz. And thank you, viewers, for participating in the CNBC TV18 budget quiz. The question was, what was the outlay for the Mahatma Gandhi National Rural Employment Guarantee Program in budget FY22? Well, the correct answer was number C. You had 73,000 crores. And here is today's winner. Congratulations, Bhupen Kumar. Remember, keep watching CNBC TV18 and win prizes daily on the CNBC TV18 budget quiz.
Okay, so that's essentially what we have for you. 170 odd points lower is what we have on our hands. So there is a little bit of a pullback from the day's lows that emerged earlier. Rajesh, in terms of your portfolio construct and everything, this is everything down kind of a day. Incrementally, what more would you want to buy?
I think if you ask me from the themes perspective, capex is a one theme which we have been talking about it, with you as well from almost like last 15-18 months. The theme is started doing very well. We are still a little bit early in the game. All indicators are not yet green. There are many indicators which are turning from red to amber, and now few indicators are turning from amber to green. But this space can be interesting as the GDP grows and capital formation start increasing. GFCF will also increase. Company's profitability, if you look at the RBI numbers for second quarter, has it reasonably strong. So that also gives you one more additional layer, incentivize companies to put more and more capital expenditure. On top of it, you have a government support in terms of PLI. If you look at the central government and state government capex for the current year, YTD, it is already higher than normal year of FY20. So there are few indicators which are absolutely very, very solid indicators, suggesting that capex is likely to revive maybe after a quarter or so. So capex is one thing which we like. Banking and finance, as I said, selectively, the valuations are quite reasonable. The asset quality issues are behind you. The credit cost incrementally is not going to go up. Net interest margins will remain quite steady, and the credit growth is going to pick up. So the quality issues are better, and the growth is going to revive. Valuations are reasonable. So banking and finance from here on will also continue to do well. And last but not least, the building material space, which we have been talking about again from almost like 1 year. We like real estate space, but instead of real estate, we have the companies which are into the building material. These are the companies which have a strong consumer franchises with a zero debt balance sheets, and they are number one in their respective fields. So I think that with the revival in real estate, these companies are likely to do extremely well over next 2-3 years.
All right, Rajesh, there was a valuation gap that ICICI Bank used to trade at in comparison to HDFC Bank. But in the last 1 year or so, that valuation gap has got narrowed, or maybe they're trading more or less, very close to each other. ICICI Bank, I think, used to trade around 2 times, its price to book. Now it's nearly 3 times odd. You still believe that ICICI Bank is good for more even from here?
I think both institutions will do well. Both are large companies. Yes, HDFC Bank was a little bit behind the curve in terms of technology. And we all hope, going by companies' annual report guidelines, we believe that probably the digital spend and the digital strategy of HDFC Bank will start showing results maybe after a quarter or so. In terms of the loan book growth and in terms of asset quality, I think both are reasonably rightly positioned. So we are not too much worried about it. And digital thing will revive for HDFC Bank. So I think both companies look good. When the country is going to grow and the credit growth is going to grow, I think banking as a space in general and winners in particular, the number one companies in their respective fields, the top 3-4 companies within banking, I think they are rightly positioned from here on. So I'm not too much worried. It's not that ICICI Bank is trading at 5 times price to book. So we don't need to worry too much about the valuations at current levels.
Right, maybe around 2.9 times price to book is what it is. And as you mentioned, it's fairly reasonable, going by it. And in fact, you have the bank in your portfolio as well. Well, Rajesh, good speaking to you. Thanks so much for stopping by. Good to discuss markets and a whole host.